Pick the monthly close each year that was the highest close of the price of silver relative to gold. And we calculate that by simply dividing an ounce of silver into an ounce of gold, express it as a percent. So you see the scale on the left goes from 0 up to 7 or 8 or whatever. And you see these bars, the highest reading you had each year. The lower horizontal line on that grid chart comes through at 2%. 21 of the past 50 years have reached 2%. Right now, we're about 1.16%. We're very suppressed, very depressed relative to that norm, okay? And in bull trends, when silver gets going relative to gold, like 79 to 80, 2010, 2011, the spread got up to 3.5%, and back in the 1980, got up to 6% plus. Okay, so just getting to a routine, been there before 21 times in the last 50 years, many of those years not even bull trends, I'd go to 2%. Well, that's nearly a double of the current valuation of silver to gold. What usually happens is when that spread breaks out, and you can't measure it that well on that graph we're looking at. But when we take it down to week action or monthly close to monthly close, and we do an oscillator, a momentum study of the spread, not just looking at the spread, we can see a breakout level not far above where we are right now that says we're going to gush. We're headed sharply toward it. In fact, since April, the silver gold spread has shot up pretty nicely. Silver is up much more in the year than gold is, by the way. Okay, so it's catching it up. But there's a breakout level on that spread that says I'm going to launch. And we define the number in our weekend reports. Once you trigger that, you're going to gush up at least to that 2% level, probably even further. But let's just say we go to the norm, 2%. Again, that's nearly a double from where you are now. Well, if gold went dead sideways at 4,000, let's say, and silver went to 2%, you do the math. Okay, $80. If silver goes to its norm, gold goes to its normal 8-fold bull trend, and let's say it goes to 8,000, which it's done twice before, remember, in terms of ratio. What's 2% of 8,000? Okay. Silver is also well below its 2011 high. The miners just took out their 2011 high, GDX, XAU. Gold's way above its 2011 high, and even a bloody base metal, copper, is currently trading above its 2011 price high. Is silver going to stay a dog forever, or is it a mistake? And you and I know, being in markets long enough, you'll find markets that get excessively overdone on the upside and are making a mistake, and other markets that get excessively cheap relative to other assets on the downside, and are ignored until finally they wake up and you say, golly gee, I wish I'd realized that. Whoosh! And silver, our argument is, the technicals argue to us, silver between now and the end of the year, in all likelihood, is going to gush past 50 and be in somewhere in the 60, 70 range. And that's not the top. I'm just saying as the first gush. Ultimately, we're going up to that 2% level. The question is, where's gold going to be? And by the way, whenever that spread breaks out, it never is the case that silver gains versus gold because gold goes down more than silver. It always gains because silver goes up net price more than gold goes up. And whenever that spread breaks out, favoring silver, it's usually an indication of verticality in both metals. Dollar index made a high at 115 back in 2022. It was still low compared to decades ago. Okay. It dropped sharply into 2023 down to 100 area and went into a dead range 2023, 2024, and early 2025, 100 to about 108. They had one spike up to 110, but basically most of the action was in about a 7 to 8% range for 2 years, which is very dull, almost non-eventful. A lot of other markets were making big moves. It wasn't. It was not a factor. When it turned down from early highs this year and got down to 104 again, actually 104.21 was the close of March, we turned major bearish. Price-wise, you're only in the middle of the prior 2 years range, but momentum said you're gone. So momentum broke. Price didn't yet. Annual momentum of the dollar broke trends that went back 10 years, sometimes more, went to the 10-year average momentum of the dollar, which is even a longer-term yardstick to measure momentum, even longer back. It broke a beautiful uptrend line that you could see on momentum, you cannot see it on price. On a price chart, what's been going on since that drop from March to April, once we made a low in April, by the way, which was coincident with the stock market low, dollar dropped sharply with the stock market. The dollar tried to bounce with the stock market, and it went into an up-down range from the low of April, below that level and above that level, 4 or 5 point swings. In every rally, everybody said, oh, the dollar's looking good. There was an uptrend line on a price chart of the dollar that goes back a decade that any idiot with a crayon could draw, and they did. And they've been buying it since the April low along that uptrend. Momentum says it's not going to hold. We're back now. This week, we've traded back under 97 this month, back down to the lows of the move again. Now, I don't think you're going to hold this time. And when the price guys finally realize, oh, my trend line's not holding. Let's say you close a month out at 96.50 or 96, just a little below where you are now. They're going to realize, oh, we made a mistake. That line didn't hold. Well, momentum already says it's not going to hold. We think you could go down into the 70s again, if not make a new low, below the low of a decade and a half ago, which would create turbulence in other asset categories. Like you've said, we've dropped, we've been bearish since 104, so you've dropped a pretty good number of points, but it's really not that earth-shaking. The next 20 points could be earth-shaking in terms of wave effects. And that's when it'll start to impact other markets that up to now haven't been impacted severely by the dollar's movement. And again, this isn't real dollar value. This is dollar value versus other pieces of paper. Yen, the euro primarily, and the yen, they constitute 70% of the dollar index.
When you look at the precious metals space, and in particular, when you analyze it through the technical lens that I've used for decades, you notice patterns that tell a story far bigger than the day-to-day noise. I don't approach gold and silver from the angle of a Wall Street cheerleader or from the hype machines that love to scream, buy Bitcoin every other day. I approach it from market structure and momentum, and right now the structure in silver is flashing neon lights. Here's the framework. We like to take the silver to gold relationship and measure it historically, not in terms of hype, not in terms of what CNBC thinks about Tesla or Nvidia, but in terms of relative valuation. We divide 1 ounce of silver into 1 ounce of gold and express it as a percentage. That tells you how silver is performing relative to gold. And what you find if you plot the highest monthly close for every year going back 5 decades is something extraordinary. The lower line on that long-term chart runs at 2%. That means historically, 21 of the past 50 years saw silver closing at least 1 month where its value was 2% of gold's price. That's almost half the time. It's not some extreme outlier, it's a recurring norm. And yet today we're sitting around 1.16%. We are not only below the norm, but we're sitting at a level that screams suppressed, depressed, and ignored. Now here's the kicker. In bull trends, when silver really gets going, that ratio doesn't stop at 2%. In 1979 and 1980, it surged past 6%. In 2010 and 2011, it ran to 3.5%. Silver didn't just catch up to gold, it trounced it. That's what happens when the world realizes that silver is not just some poor cousin of gold, but the people's money and an industrially critical asset rolled into one. So what happens if we simply go back to 2%, the recurring average, not even an extreme? At today's gold levels, around $4,000, that puts silver near $80. And that's without gold going anywhere. That's with gold flatlining. If gold does what it has done in past bull runs and doubles again, let's say it goes to $8,000, then 2% of that is $160. And again, that's not even extreme. That's just getting back to the historical routine. And here's something important. When that spread breaks out, it's never because gold goes down more than silver. It's always because silver explodes higher, outpacing gold's own rally. Momentum studies confirm this. If you zoom in month to month, week to week, the oscillator readings tell us we are on the cusp of a breakout. We've been suppressed for too long, and the spring is coiled. Since April, the silver-gold spread has risen nicely. Silver's gains this year have already outpaced gold's. We're not just in theory land, this is happening in real time. Now, why does this matter? Because spreads like this don't just tell you about silver, they tell you about verticality in both metals. When silver begins to outperform, it usually signals that both gold and silver are entering an acceleration phase. Not a grind higher, not a slow and steady wins the race, but a vertical move that leaves people stunned. Look at history. In the late 1970s, as inflation surged and confidence in the dollar collapsed, gold soared, but silver went parabolic. In 2010 and 2011, as the Fed rolled out QE and global debt looked unstable, gold soared, but silver sprinted to $49 in the blink of an eye. This is the dynamic repeating, and the technicals are telling us the ignition point is here. Let's talk about the dollar for a second, because it's part of this story. The US dollar index peaked at 115 in 2022. That was already a weak showing compared to its levels in earlier decades. Then it dropped sharply into 2023, down to 100. And for 2 years, 2023 and 2024, it just bounced in a boring range between 100 and 108. One spike to 110, but mostly dull. Meanwhile, other assets were making huge moves. The dollar was on autopilot, but markets don't stay asleep forever. In March of this year, we called a major bearish shift. Momentum cracked even while price looked stable. That's the beauty of momentum analysis. It sees what the eye misses on a price chart. Long-term momentum broke up trend lines that went back a decade. On annual momentum, the dollar failed at its 10-year average. These are seismic breaks you don't see unless you're looking under the hood.
Bank reports that I've read or heard about of analyzing their customers that are invested in the market and have an account in the bank that does that. The use of leverage has never been higher than it is now, and yet it's persisting. Okay, so you can make an error, but keep making it, and the longer you make it, the worse the consequence probably. But again, the issue is when. Okay, yeah, it's a reality; those are objective facts. But again, when, and that's what we're focused on. And I do think it's a key factor right now because when it does crack, we know what's going to happen to the central bank. They're going to go berserk, even more so than they already are. Which case they'll lower rates, but they'll also increase money supply, et cetera, et cetera. But and that will impact other markets as well, because when they push the throttle, especially gold and the monetary metals will accelerate even further. Not that they're dependent on it, because they've already anticipated that event. Money's already started to flow. Not particularly American money, by the way, but other parts of the world have gone into the monetary metals. Wait till that starts. I think it's already begun, and I think that's why you've seen gold miners go vertical, especially since April. Remember, gold made a high in April when we interviewed last time. Gold was up to, I think, 3,400, and it went dead sideways for 5 full months. They sold it, and they sold it, thought, oh, this is the top, this is the top. It wasn't at the top. It was just a sleepy range. What happened since then? Miners exploded while gold went sideways. Silver went from mid-30s, lower 33, 34 area for a year. In fact, it had been, in last May of 2024, it was up to 32.70. So you could draw a line across that high through the next year of action, and you did this on either side of it. And it wasn't until late June, July, you finally went through the highs. So July, August, Sept, boom, silver goes from mid-30s to what? 43, okay? So while gold stood still. Now gold's starting to reassert itself here. But I think that money flow that went into gold miners was from asset managers, largely the larger ones, especially Newmont, which has gone vertical for the last few months, who've decided, hey, they know the stuff you just mentioned. Too many points of excess. I think I'll move 2-3% into the gold miners. They look undervalued. Gold's been doing good. No, I'm not a gold bug, but I'm going to move some money over there. But when they do, it's wet bar of soap time. Squirt on the upside because it's such a small sector. And I think that probably some of the power that's driven that is the doubtful asset managers in the stock market. Can't prove it. Just an assumption. Yeah, right now, if you look at a monthly price chart, just a regular arithmetic scale price chart, and it'll go back to 2011 high, and you had the drop into 2015, 50% drop. And from 2015, you worked your way up, but it was an arm wrestling process. In fact, there was 120% correction in there between the early 22 high and it was August 22 low. You went from 2,000 down to 1613. Okay, pretty nice drop, 20%. And then you reasserted yourself, but it was an ongoing, arduous process. And only now has it started to look like it's accelerating. And so if you looked at a bar chart of weekly or monthly gold, and you're an average investor, you say, boy, that's been glorious. I'm glad I was in that. And you're thinking, God, it can't go forever like this. But when you look at a ratio scaled chart, in other words, percent gain of a bull market.
All right, let's continue where we left off. We've established that silver is cheap relative to gold. Not just cheap, generationally cheap. We've shown how the historical silver to gold spread points to levels 2 or 3 times higher than today. We've looked at momentum cracks in the dollar that scream turbulence ahead. But to understand why this matters beyond the charts, you need to see silver for what it is, the people's money. Gold has always been the money of kings, of central banks, of sovereign wealth funds. Silver, on the other hand, has been the money of the marketplace. Farmers use silver coins. Merchants exchange silver. Ordinary citizens saved in silver. And there's a reason for that. It's accessible. Even today, an ounce of silver at $40 to $50 is within reach for anyone, while an ounce of gold at nearly $4,000 is out of reach for many. When confidence in paper currencies collapses, the masses don't buy kilos of gold, they buy handfuls of silver, and that's exactly what terrifies the monetary elites. They can manage gold in the sense that central banks hoard it, lease it, play their games on COMEX. But silver? Once the public rushes in, the supply-demand dynamics go ballistic. Because unlike gold, which sits in vaults unused, silver gets consumed. It gets put into solar panels, electric vehicles, medical equipment, electronics. Half of silver's demand is industrial. It doesn't just sit there. It gets used up. Think about solar. The International Energy Agency projects that solar will account for over half of all electricity generation growth in the next decade. Each solar panel requires silver. Multiply that across millions of panels, across China's green push, India's growth, Europe's energy transition. You get a structural demand boom. Now add EVs. Each electric car consumes 25 to 50 grams of silver. Global EV sales are expected to hit 40 million a year by 2030. Do the math, that's another 100 million ounces a year of new silver demand, minimum. Meanwhile, supply is flatlining. The Silver Institute reports global mine production at around 850 million ounces a year. Recycling adds another couple hundred million. Demand in 2023 was about 1.2 billion ounces. That's a deficit of over 100 million ounces. The third straight year of deficit. Where's that extra silver coming from? Stockpiles. And stockpiles are draining fast. That's why you're seeing anomalies like lease rates in London spiking to 6%. For decades, lease rates hovered below 1%. Even in stress events, maybe 1.5%. Now, 5 to 6%, that's a neon sign flashing, no silver available to borrow. That's what tightness looks like. It's why I call this the most asymmetric opportunity of our generation. You've got flat supply, soaring demand, and the public not even in the market yet. When they arrive, it's game over. Right now, this rally is being driven by the smart money, the insiders, the central banks, the sovereign funds. India's imports are massive. China is hoarding doré bars, even flying concentrate across oceans for refining. Russia, Saudi Arabia, BRICS nations, they're buying hand over fist. This isn't random. This is preparation. Meanwhile, what's the average American doing? They're buying meme stocks again. They're trading options on companies that don't make money. They're betting on crypto coins that were literally created as jokes. It's the perfect contrarian signal. The big money moves in the shadows while the public yawns. Then one day, silver gaps $5 higher overnight. CNBC runs a segment asking, "What is silver?" And suddenly the stampede begins. Let me bring in a little humor here, because sometimes the absurdity of it all needs a laugh. I saw a tweet last week that cracked me up. The day silver hits $100, CNBC will finally call in an expert who tells viewers it's too late to buy. It's stacker humor. And you know what? That's exactly how it goes. By the time the media blesses it, the easy gains are gone. Now let's circle back to the dollar. Remember, momentum broke before price. Annual momentum cracked trend lines going back a decade. Price hasn't yet reflected the full collapse. But once it does, it'll be violent. We could see the dollar index plunge into the 70s. That's not fantasy. It's what momentum projects. And when the dollar weakens like that, everything priced in dollars revalues higher. Gold, silver, oil, copper, food, real estate, you name it. But there's an added layer here. The dollar isn't just weakening, it's being abandoned. BRICS nations are openly trading in local currencies. India is buying Russian oil in rupees. China and Brazil are settling in yuan. Saudi Arabia, America's longtime partner in the petrodollar system, is flirting with non-dollar oil deals, and central banks are loading up on gold instead of treasuries. Now let's tie this back to the psychology of big versus small money. Big money, institutions, sovereigns, billionaires. They ask every day, where do I put my wealth? Stocks are at all-time highs. Bonds are shaky. Real estate is peaking. Banks are undercapitalized. Insurance companies are exposed. Where do you go? That's why they're buying metals. Quietly. They don't ring a bell. They just act. The public, meanwhile, waits for confirmation. They want Jim Cramer to say it's safe. They want CNBC to feature it. They want their neighbor to brag about it. And by the time all that happens, premiums on Silver Eagles will be 50%. Inventories will be wiped. The opportunity will be gone. This is why I keep pounding the table. Don't wait for the crowd. Don't wait for the media. Don't wait for the obvious. The obvious is expensive. The contrarian is profitable. I'll close this section with a forecast, and I say this with conviction. Silver will not just test $50. It will blow through it, likely into the $60 to $70 range on its first surge. That's not the top. That's just the breakout. Over the next few years, as gold heads toward $8,000, silver will normalize toward 2% of gold's price. That's $160. And if the momentum overshoots, as it did in 1980, 200 plus is not crazy. And when the dollar collapses into the 70s, when headlines scream currency crisis, when BRICS launch their gold-linked settlement, when miners triple in months, the same people ignoring silver today will be the ones saying, why didn't anyone tell us? Well, I'm telling you now, stack silver, hold gold, own miners, because the charts, the momentum, the history, and the tectonic shifts in global finance are all aligning. And when markets make mistakes, like undervaluing silver for a decade, the correction isn't polite, it's violent. This is the setup. This is the opportunity. And in my judgment, it's once in a generation.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.